What's up, everybody? I really appreciate you joining me again today. Today we're going to learn about one of the charts that I put out with analysis about what's going on the options market for that day, and I call this chart my key levels chart. There's a couple of different really important things that are going on there and a couple of really important concepts to understand. And so today is going to be much more about learning how to look at the chart and what the concepts stand for rather than doing a big rewind and watching how it plays out. So if you can understand what the importance of these levels are, you'll understand maybe where the next day is headed. Let's jump into the charts. Now, like I said earlier, this is going to be a little bit different from the previous videos in that this is going to be more about talking about what you're seeing here on a static chart versus rewinding it and sort of seeing how the indicators play out in real time. That won't really serve the same purpose today, so we're not going to do it. So what you really want to pay attention to are, what are all these levels, what do they all mean, and what kind of insights can they give me? And so most of everything is labeled off to the right, which we'll get to in a minute. There's also a couple of things here in the middle, and you see up targets, down targets. What are those? So the ones that are closest to the ticker, this green one here, this red one here, those are factored in from implied volatility. So if you're not familiar what implied volatility is it reflects the market's expectation of future price fluctuations for a stock or an option, and it's derived off of an options pricing model. So a way to think about it is, imagine you're holding a balloon and you go to blow it up. You don't know exactly how big it's going to get, but you have an idea based on other balloons that you've blown up before. This is, in a sense, like trying to guess how big the balloon's going to get before it pops. If people think it's going to get really big, then it has a high implied volatility, and the stock price may move a lot. If the balloon stays pretty small, then the implied volatility is pretty small. So in short, it's going to kind of help us gauge how much the price of something might change in the future. You know, within reason, most of the time, the implied volatility target, if it's a non-news day, like an earnings day, or there's major overall systemic news, we don't really get a chance to see us hit those targets too often. Those do come into play a little bit more during, say, earnings calls, or if there's unexpected news that comes in. The upper and lower targets, the ones that are much higher and much lower, have a historic volatility factored into those. And what the historic volatility is it's going to measure how much of a price has fluctuated in the past over a certain period of time. So unlike implied volatility, which is based on future expectations, historic volatility looks back at the actual price movements. And so I have found that you can combine the two through a formula that helps give us kind of what a maximum expectation is when there's the unexpected. And so let me go ahead and I guess suppose re-explain what that historic volatility really is, you know, if you imagine you're watching a roller coaster, sometimes it goes up and down really fast, sometimes it's slow and smooth. Historic volatility is just like remembering how wild the roller coaster's been over the last couple of days. If it's fast and bumpy, then obviously we've had a high historic volatility. If it's slow and steady, then, you know, we've got a lower historic volatility. So sort of back to where this comes into play is I have found through just sort of trial and error observation over the years that comes into play when there's a big piece of news that comes out, such as in recent times, Fed days, CPI days, because we've had since the post-pandemic era a lot of surprises about different rate changes or inflation expectations. On those kind of days where you get a really unexpected event, sometimes we hit those upper and lower implied and historic volatility targets. And, you know, when that happens, this is kind of a way to look at it and say, you know, if I'm a betting person, you know, what is my worst and best case scenario for the day? Those are a fairly good way to look at it. Of course, there's no guarantee. It certainly could do worse or better, but in general, that's going to give you a pretty good target of what your best and worst outlook is for the day. Again, keep in mind when we're looking at this that I set this up just for example purposes, and that you shouldn't trade off of this chart if you're watching it the next day, because this information is not accurate. I kind of spaced things out so that we could get a better idea of what they were, so I wanted to make them stand out. Okay, so I went ahead and turned a few things off here so we can get a little bit of a better look. And this is the part where I cover what really are the key levels here. And you can see where these are actually labeled with key levels. Let's start off with the extremes. We have the call wall and the put wall. As the name implies, the call wall is the strike price where the highest open interest in call options are for a particular expiration date. Why that's a key level is that oftentimes it ends up acting as resistance, because as the stock approaches that level, then call sellers may have to hedge their positions, which limits further price increases, and traders can kind of generally expect to have the stock having a harder time rising above that level due to the pressure from all of the open call options. So when that stock approaches, the call wall sellers of those options might sell to hedge, and that's what's going to kind of put some downward pressure on it in order to hold it there. And then flip-flop that with the put wall, which is the strike price with the highest open interest of puts at a specific date. Same sort of concept of rehedging has to occur there, and it can be pretty difficult to move that. So that kind of becomes sort of your ultimate support for the day. Then, of course, we do actually have these resistance points and support points. And the support and resistance is there through different forms of looking at where the stock has moved in the past and different technical analysis to establish those. And you'll notice that they are shaded in so that they kind of stand out, and then there's some shading in between the put wall and support and the call wall and resistance. And oftentimes during the day you'll see if it's a volatile enough day. Now I have this a little bit spread out. Some days this is a much more narrow range. This is just there for example. But what that's going to do is say that on most days we're going to stick within support and resistance fairly well, again, unless there's a piece of news that comes out or some unexpected event and it wasn't accounted for, and that's where again those implied volatilities can come in. And then here in the middle I have this colored in yellow for a reason, and it's there to catch your attention. We have two more levels. We have max pain and the zero gamma, and I'm actually going to cut away to a separate video to kind of show you the concept behind those. Alright, so I thought I'd show you an analogy rather than show you an actual options chart, which we'll do at another time. But the zero gamma is the point where the gamma value flips. And so for options that are in the money or out of the money, the gamma tends to decrease. But for at the money options, the gamma tends to peak. And so as the options move from in the money or out of the money and then vice versa, the gamma transition from positive to negative or the other way around is where the zero gamma is. So if you think of gamma like the steepness of the hill, showing you how fast your speed is, how much you're going to gain or lose, changes. And so the positive gamma means you're on the hill where things are getting better for you as the stock price moves, and it's like riding downhill. But the zero gamma is the point where you switch and it becomes very difficult. The max pain is the point where options holders experience the most losses and option sellers, the writers, experience the least losses. It's the stock price at expiration that causes the most options, both puts and calls, to expire worthless. Another way that you can think about this is imagine that all of your friends have balloons and they're trying to pop them at the same time. Everybody wants to win, but you're somehow in the middle trying to keep the most balloons from popping. That's the spot where you manage the most balloons and keep it from popping. It's the max pain that your friends feel because you win the bet about who's going to pop the most balloons. Alright, so back into the chart here, I want to go over another important concept here that I've turned everything else off except for these single prints. What is a single print, you're asking? Well, I'm going to do a separate video on where these come from, but they come from a volume profile. And so the volume profiles, you may have seen them, they usually run along the vertical axis of a chart, either on the left side or the right side. But essentially what it is it's a point of like market rejection. Often it's a price level where the market has quickly reacted to a certain price and it moves away from it swiftly. So this can indicate like a strong consensus among traders that that particular price level is undesirable. But what it does is it left that there was no room for price discovery around that point. And because of that, single prints, as they say, get filled. So they usually get re-explored at some future time, and they end up becoming a potential for support or resistance because these levels were so quickly rejected that, you know, they end up kind of becoming some places like a no man's zone. So another way that you can think of it is if you were playing like a game of hot potato. This is some place where the potato was like really, really hot and everybody passed it around super fast and nobody wanted it at that point. So the single prints are there because at some point they're going to get explored again, and they can function as support and resistance, so they are important levels to keep an eye on, and that's why we have added single prints to the key levels chart. All right, now we're going to talk about the ADR targets, which are some important key levels as well. Now, what is the ADR? Well, ADR stands for average daily range. And as you may imagine, what it is it's used to measure the expected price movement of a stock on a single trading day that's based on its historic price movements. So there's usually a look back period which you can change and adjust based on how many days you want or how many bars you want to have considered in the calculation. But what it tries to do is look at the range that has occurred during that day. So it's going to look at the highs, it's going to look at the lows, and it's going to try to come up with a possible path of, you know, here's the high and here's the low, and that gives us some idea on hopefully what the volatility might be. So it's another quick way to sort of visualize what kind of a volatility range you're going to be within. You know, you can kind of think of this like if you had a toy car and you were pushing it along a track. You know, some days you might push it a little further than others. Some days it might go fast, some days it might go slow. But after watching it for a number of days in a row, you kind of get a sense of, hey, if I push this car down the track, here's how many feet it goes on average. That's what these ADR targets are really there to do. And so there's two different ways that they're marked on the chart. The first one is over on the right. You can actually see where the target is at, but I've also created these blue and I guess purplish pink ADRs that will move along with the chart, so you can sort of see the range develop in real time. And again, depending on what the look back period is, they're more responsive or less responsive as you try to establish the range. So the ADR targets are valuable enough that I'm actually going to put those in another video that's going to include some other concepts that are similar to ADRs. But those are a part of the chart because, again, they're another quick way to gauge the volatility and possibilities with a glance. Okay, so the last element I want to separate out for you are these invalid moves. Now this one you're going to have to stick with me and have a little bit of faith, because I am going to put out a separate video dedicated to how I find these invalid moves, but I'm not going to get into that today. So you're going to have to stick with me that these are important levels. And the reason they're important is because I came up with a system that over the years I have found a way to see things that tell me that this is a point that has to get explored again. It's not a matter of if it's going to happen, it's a matter of when it's going to happen. That's the unfortunate thing about the time, and you'll see in the next video related to this why that's the case and why time isn't a factor. I have seen some of these invalid moves go as long as a calendar year before they end up getting it re-explored, but they always get re-explored. And so again, I put these up here on SPY today not because these are real invalid levels. I put them there as an example so you could see what they were. But that's what they represent, and so these are going to act like magnets at some point. Once we start moving towards these, we tend to stay moving towards them. It might not be a straight path up or a straight path down back to them, but you'll start to see some momentum pick up. We'll get real close, and sometimes it'll kind of freeze right around that level, and then eventually it'll fall and hit it. But it is a matter of when, not if. So time is not, unfortunately, a factor, but they're important enough levels and they retrace frequently enough that I've added them to my key levels chart. All right, so we're back kind of putting this all together for one final look at how it's all supposed to kind of fit together. So we're going to use those ADR targets to kind of look and see what the range might be. We're going to use the resistance and support points to kind of know what the range might be. We're going to look for the 0 gamma and the max pain to kind of say where might we get pinned. We're going to look at the IV targets as a range for a volatile day, and then we're going to look at the extremes of the call walls, the put walls, the IV targets with the HV factored in as the extreme for newsworthy days. So with that is the key levels, and I hope you enjoyed it. All right, everybody, thanks for joining me today to learn about the key levels. Remember that all of these individual levels have their own little nuances, but putting it all together, it gives us a great picture of how the day goes. And happy trading. Good luck.